Hello, hello, hello. Welcome to my first video for chapter 4. In this video, we're going to start talking about some schemes. So it's kind of interesting to hear different ways that some of these asset misappropriation schemes can take place. So this chapter is titled Cash Receipt Schemes and Other Asset Misappropriations. So in this video, I'm going to talk about the cash receipt side, and then I'll have a second video for other asset misappropriations. So first, let's talk about skimming. So skimming is when we steal cash before it actually enters the accounting system. So it's called an off-book transaction. So skimming happens when we are taking cash at some point before it can actually get recorded. Because of this, there's no direct audit trail, meaning we don't have a record that the cash took place or that the sale took place. And that can make it very difficult to detect because we don't know where or when it happened. So two main places where this typically happens is either at the point of sale, so when someone is making a sale and handing over their cash, or at the point of receivables. So we've already made the sale and now people are just paying for their goods. So those are the two main categories or places where we will see skimming. So let's talk about this in a little bit more detail. So sales skimming is the most basic skimming scheme that we can see. This is when a customer is making a payment and we take that payment without making any record of it. So a good example is at the movie theater. Sometimes you go and they don't have the box office open and you just go up to the concession stand and you get your tickets there. There's nobody there to tear your ticket. You just go on in and go to the theater. So what if someone says, okay, you owe me $10 for your ticket, but never actually records you getting the ticket and you just go on into the movie theater? That would be an example of sales skimming because they're not actually recording that you went in and paid for your movie ticket. So there are a number of different types of sales skimming schemes. Say that 5 times fast. That I want to talk about. So a lot of these talk about a very manual process, but that doesn't mean that it couldn't also happen in a more computerized or high-tech process as well. So the first one is cash register manipulation. So in a cash register, there's going to be a register tape that will track all of your transactions. So in cash register manipulation, either we ring up a no sale, so there should be nothing, no sale recorded, or maybe a voided transaction or something like that. So the drawer is opening up, but no sale is actually recorded. They could also manipulate the tape. So the sales tape is what records all of the sales. So they could either alter or manipulate that tape in order to cover up the sale that was stolen. After hours sales, so this would be maybe opening up before the store opens up, or staying open later, or opening up on weekends when things aren't usually there. And then any sales that occur during that time don't get recorded, or you take the tape that would have been during those hours and destroy that tape so no one knows that sales were actually recorded during that time. This is going to lead to some inventory issues, obviously, because you're making sales, which you're selling your inventory. So that's going to also impact so inventory will also be impacted during our after hours sales. Off-site employees. So employees that don't work like in your typical office, but maybe are going out and doing work off-site and don't have a whole lot of supervision. They work very autonomously. They could also have issues where they skim sales. So where I used to live, there was an article in the newspaper about the woman who ran the dump. So just like the movie theater example, she ran the dump. People would come in to dump their garbage, and she would take their sales without recording them. But she didn't work like in the normal office where the rest of the government employees worked. She just worked in her little hut at the dump. So it was very easy for her to steal those funds without anyone knowing, because she didn't have anyone else there to kind of watch her. Poor collection procedures. A lot of what we talk about will, say that the reasons that these things can happen is because we have poor segregation of duties. So poor collection procedures is similar to that. So if we have poor collection or recording procedures, it can make it very easy for an employee to skim sales or receivables. So for instance, if we just have, instead of writing down all of the individual sales that we make for the day, we just write down a total. So we wouldn't know what that total should be because we wouldn't have a list of each of the individual sales. So if we don't have good controls, that would open up the door for some of these thefts to take place. Understating sales. This is purely off-book sales. So if sales should have been $1,000 and we're only recording it as $700 and taking the other $300, this could result in some sales skimming. Check for currency substitutions. What this means is you're going to take unrecorded checks that and then just substitute them for cash. So this happens if maybe we get a check we weren't expecting. So let's say a check comes in for like a rebate or an insurance refund or something, and we weren't really expecting that money to come in. So we could just take that check and go over to our deposit for the day and take the equal amount of cash for that check. So let's say it was a $500 rebate and no one was really expecting it. So there's not an accounts receivable for it. It's just like kind of some bonus money that comes in. So we go over to the deposit and we take $500 in cash and put that check in with the deposit, and we've stolen $500 in cash, and no one really notices it because that check was kind of unexpected. The last one is theft in the mailroom. I talk about this one a lot in my audit principles class. Basically, whenever we have cash coming in or have the mailroom where people are opening checks, we should have 2 people doing that process. We need to make sure we have oversight because anytime you have cash or checks coming in, that occurrence of theft is there, or chance of theft is there. So having 2 people in the mailroom to process incoming checks is always a good control so that people can't steal them as they're coming in into the mailroom. So ways that we can prevent or detect sales skimming, obviously having good internal controls is always going to be top of the list, but also having good visible oversight. So if someone is watching you, it's going to be hard for you to like take cash out of the cash register and put it into your pocket. So making sure that we have either management presence or video cameras where people think they're going to be caught. So remember, that second leg of the fraud triangle is perceived opportunity. So if you don't think you can get away with it, and you don't think that that opportunity exists because someone's always around watching you, or there's a video camera watching you, then you might not do it. Customer complaints and tips. So customers are the ones that are there at that point of sale. So if they see you slipping cash into your pocket and then they come and tell your manager, that would be a good way to prevent or detect it. Also maybe doing some like customer satisfaction surveys. So calling your customers and saying, hey, how was so-and-so? And, I see that you didn't make a sale. Maybe this is like an offsite salesperson who logs that he visited a client and didn't make a sale, but he really did. So if you call and say, hey, how is he? Why didn't you make a sale? What can we do better? And they say, oh yeah, I did make a sale. Then that would give you some indication that there was some things going on. Cash register login and log out times. So we know who's logging in. We know who has access. We have that that record of who has been in our cash register at any given point of time. So having that that measure to help us detect after hour sales. So if people are logging in at times that they shouldn't be, that would help us with that as well. Activity logs for offsite personnel. We should know what it is that they're doing and where they're going. Again, doing those customer satisfaction calls to help verify that information that the salesperson is telling us. And just reducing that perceived opportunity. So we want to make sure that the employees don't think that they have an open door where they can steal and get away with it. We want them to think that we have strong detection and prevention measures in place so they don't go ahead and make that that leap and steal the funds. The next one is receivable skimming. So this is a little bit more difficult than the sales skimmings because receivable payments are expected. So someone has made a sale and they're sending in their payment. So we have an accounts receivable already booked and we're expecting to get paid for that. It's not like a sale that isn't expected and isn't recorded. Here we have that receivable already in there and we're expecting to get payment for that. So when this occurs, they don't record the payment. So they steal a check for someone who's coming in and then they don't record the payment. So this can have some unintended consequences. So some of the types of these receivable skimming schemes include lapping. So lapping is like borrowing from Peter to pay Paul. So this is the most common method. And in this, here's an example. So let's say we have 3 customers. So we have John, Betty, and Sally. So when John makes his payment, the fraudster is going to steal John's payment. And then when Betty comes in, she's going to apply Betty's payment to John. And then when Sally comes in, she'll apply Sally's to Betty. So it's just like you're always applying someone else's payment to whoever you had stolen to help cover your tracks. So oftentimes fraudsters will actually have a second set of books detailing the true nature of these payments because it can get really messy, as you can imagine, if you're always paying this person for that person and all of these things. So they have to kind of keep track of whose payment has been stolen, whose needs to get covered up. So they might actually be keeping records for you of whose payments they have stolen and where they are. So this just, again, that just helps them to keep track of the funds that have been stolen and what has been credited and what needs to be credited. The next one is forcing balances. So this is the most dangerous receivable skimming scheme. And this is where the perpetrator is in charge of collecting and posting payments. So this is someone probably that is going to have some lack of segregation of duties because they have both custody and record keeping responsibilities. And here they can falsify the records to conceal the theft. So what they would do in this case is post an incoming payment to a customer's accounts receivable, even though the payment will never be deposited. So this keeps the accounts receivable from aging. So we're not going to get a call saying, hey, I really did pay my bill. What happened? So they're not going to get that bill. It's going to keep it from aging because they're showing that it's paid. But that's going to create an imbalance in the cash account because we're recording the receivable. The other side obviously has to be cash. So what they'll do here is instead of putting it to cash, where that would make the cash account off, they will just force it into something else. So this could be it could be some sort of expense or like a refund, something. So they'll just force the balance so that the accounts receivable is correct and the cash is correct. Another thing they can do is steal the statements. So the customer statement gets made and it's going to show that they didn't pay their bill. Well, if they get that statement, they're going to be pretty mad because they know that they paid that bill and they don't want to have to pay the interest or the fees that comes along with paying that bill late. So they're going to call right quick and you're going to get found out. So one way to cover this up is to steal the statements that should go to this person account. So maybe you have it, you go into the system and you change the person's address so it gets mailed to your house instead of getting mailed to their house. And then you might create a fake statement that says, here's your real balance. And you might, and so they would just want to know. So that is what you would do in stolen statements. Fraudulent write-offs. So here the fraudster will find some way to bring the accounts back up to date in order to conceal their crime. And they'll do this through fraudulent write-offs of the customer account. So if John paid his bill, he knows he paid his bill, but I stole it, what I can do is write John off as bad debts. And then the accounts receivable isn't showing that he owes a balance because we've written it off. John's not getting a statement because he no longer owes those funds. Everybody's happy because it looks great, except now our discounts and allowance accounts are off because we're writing off debts that should have been received. We could also debit the wrong account. Again, instead of debiting cash, because the cash doesn't get deposited, we could put it into another customer account that's about to be written off. Or we could put it into somewhere else where it will go unnoticed, like a really large account where just a small little journal entry won't make a big difference. And if all else fails, the other thing they can do is just destroy or alter the records. So destroy those accounting records to cover their tracks. So either the store's copy of a receipt or the cash register tapes, they could just destroy those so no one would know what the sale is supposed to be. So how can we prevent or detect receivables skimming? So again, this is a breakdown in the organization's control. One person has too much power. We need to have proper segregation of duties. That's always going to be probably the biggest thing. So we need to have strong internal controls, separation of duties, regular rotation of job duties. So if we don't always have the same person recording those payments, they're not going to be able to lap those payments like we would expect. So it would be caught at that point in time. Similarly, if the person is taking a vacation, someone else is responsible for those tasks, it will get caught. Supervisory approval for write-offs. So like I said, one way to force this is we're going to write this person's account off. So I'm going to steal the money that he paid, but instead of recording that as received and crediting that to our receivable and cash account, we're just going to write it off. So that's another way that we can make sure that these things don't happen. Independently verifying that our deposits match the receivables posting is another thing that we can do. Reconciling our bank statement to make sure that what we're showing is deposited is always helpful. Spot checking the deposits to the accounts receivable. So the amount that was deposited should agree with the amount that we received, and the amount that was offset to those accounts receivable. So making sure that those things match is another good thing. So cash larceny. So the difference between larceny and skimming. So larceny is identified as the intentional taking away of an employer's cash without the consent and against the will of the employer. So whereas skimming was defined as theft of off-book funds, cash larceny schemes is the theft of money that has already appeared on the company's books. So larceny, again, skimming is off-book and larceny is on-book. So That's the main difference that we see here. So this happens anywhere where an employee has access to cash. So point of sale, so at a cash register, incoming receivables, and finally when we're taking deposits to the bank. Those are the three areas where this can occur. So point of sale. So when we're making the sale, we're at the cash register. This is the most straightforward scheme. You open up the cash register and you take some cash. So that's, the most common and, where we'll often see this. So after we steal money from the cash register, how can we cover that up? So one thing we can do is steal from other registers. So maybe when, maybe I have I'm on register 3, and when my neighbor on register 4 goes on lunch, I go and steal money out of her register. So that it looks like she stole the money and I didn't steal the money. So stealing from other registers. Sorry. The next way is the death by 1,000 cuts, stealing just a little bit over time. So that's what we mean by death by 1,000 cuts, is we're just taking a small amount, every day. Maybe every day we take $5 or something to go buy lunch. So we're taking just a little bit at a time, but over an extended amount of time. So if we do that, we're going to say, oh, it was just an error, it's over, short, it's fine. So to track that, you should keep track of each of your employees over and short. And if they're short by the same amount multiple days in a row, that would give you some indication that something has happened, because your overage and shortage, some days you might make an error in one direction, and some days you might make an error in the other direction. But if you're always in the same direction, that's not a good thing. Reversing transactions. So having like false voids or refunds. So you ring up a refund on your cash register, let's say you work at the store and you ring up a return that never happened, and then you take the money from that return. So having management approval of those returns is something that we can do for that. Altering cash counts or register tapes. So in this case, at the end of the day, whoever is running the cash register should do a cash count, and it should equal what they say the sales is. So if an employee has $1,000 worth of transactions and then steals $300, there would be $700 left in the cash drawer. So what we want to see is a reconciliation of those two. But how can they get away that? They can alter the cash count or register tape. So they could alter that register tape to say, nope, I didn't have $1,000 worth of sales. I should only have $700 worth of sales. Or alter their cash count sheet and say, yep, I had $1,000 in my register. So if we don't have somebody there that's reconciling those two, that could be one way that they could get away with it. And then finally, just destroying the register tape. So the register tape is what we compare that cash count to. And if there's nothing to compare it to, how do we know what it should be? So destroying that tape is another way that they can get away with it. So again, ways that we can prevent these sorts of cash larceny. Strong internal controls. So independent checks over the reporting and the receiving process, segregation of duties. So the big ones, like we think about all the time. Any discrepancies should get looked into. We want to see that we have that cash count and the register tape and that those amounts agree. We should have, so what we should have, so here's what we should see. We should see person who's responsible for that cash register does all their transactions during the day, and then at the end of their shift they count up their cash, they prepare their little cash count memo that says how much the cash they have, and they hand that cash over. And then another employee, someone else, this is that segregation of duty, is going to pull that tape out of the register, and they're going to count the cash and make sure that those totals agree. So they're going to say, okay, that you said you had $700. You do have $700. The tape says you should have $1,000. Where's that 300? So we have that proper segregation of duties. Also relating to our discounts, returns, and adjustments, we would like to have a periodic report that shows the number of discounts, returns, and adjustments and write-offs and anything else that could conceal some of these transactions. And we're going to want to see it by employee to see if there's any employees who have a significantly larger amount, or a department or a location, to see if there's, as a percentage wise or as an increase, if we see anything out of the ordinary. All right, larceny of receivables. So again, stealing incoming customer payments on accounts receivable is what we're talking about here. So when we're talking about skimming the receivables, that's when the payment has never been recorded. Larceny of receivables means we steal the funds after it has already been recorded, which means that it's classified as the larceny. So here's an example. An employee posts all records of customer payments to date, but then they stole the money received. So they already recorded it, but they stole it before it actually before it was actually deposited. So this is going to make your cash account off because, or out of balance, because you're because you've stolen those funds and they're not in your bank account. So in order for an employee to succeed at this cash larceny scheme, they must be able to hide the imbalance that we see where that's not where we have that difference between what that you say you should have in cash and what you actually are showing in the bank. Ways we can do this: forcing a balance, reversing entries, and destruction of records. So forcing a balance is when we make unsupported entries on our books that are going to fictitiously lower that balance that we're showing. Reversing entries, so posting the payment to the customer account and then reversing the payment so the cash side doesn't show up. So it could be some other unauthorized adjustment like discount courtesy discounts or returns. So having those reversing entries, so we're showing that they made the payment, but then we're going to reverse the amount of the cash that we stole so that it doesn't look like we're owed that much cash. And then finally, destruction of records. This is the slash and burn concealment strategy. So we're just going to destroy all of our records so we don't know how much cash we should have, and it is what it is. Cash larceny from deposits. So the second type of cash larceny, or I guess this might be the third type, is when deposits. So this is the last step before the cash actually makes its way into the bank. So we've recorded the transaction, and as we're taking it to the bank, we're going to also take some money and not deposit the full amount. This is very difficult to conceal and therefore kind of easy to catch. So what we should see is someone is preparing a deposit slip for the bank, and then another employee, preferably, is going to take that cash and deposit it in the bank, and they're going to get the deposit slip from the bank. So we'll have one deposit slip from the person who prepared the deposit and one deposit slip from the bank showing how much was deposited. Those two should be matched up and make sure that the amount agrees. Some ways that we can get around this: lapping. So this is just kind of like delaying some of those deposits. So I'm going to steal a deposit from today and replace it with tomorrow's deposit. So just like in the receivables lapping, where we're using one payment to cover the theft of another payment, we're going to use one deposit to cover the theft of another deposit. If we're constantly just kind of one day behind, it could be pretty difficult to detect. If you continue to steal, it could possibly show up. The second is to carry the missing money as deposit in transit. So every time when you do your bank reconciliation, any money that you have stolen, you would just show up as deposit in transit. So that deposit in transit amount could get quite large. And eventually someone's going to look at it and be like, why is this money still in transit? Why hasn't it ever hit the bank? So these, again, are some of the more difficult ones to find. Ways that we can prevent or detect these things, again, having that good segregation of duties, making sure that we're matching up those deposit slips. The itemized deposit slip will also tell us all of the various checks that we had, so we can match those up, the total amount of cash, so that we can see those things. So this is having that deposit slip from the bank, comparing that to our deposit slip, making sure that they agree, making sure that they're posted to the general ledger at the same time. Have 2 copies of the bank statements to different people in the organization. So this would help, again, with that segregation of duties, where you kind of have someone else looking over your shoulder. All right, that concludes my first video. Check out my second video about other asset misappropriations. Have a great day.